$1.4 trillion. That is the global asset base sitting inside Robo-Advisor platforms. As of the most recent industry valuation published by Market Research Intellect in September 2025, with projections pointing toward $3.2 trillion by 2033. The word attached to that money on every landing page in every onboarding flow is personalized, personalized portfolio, personalized risk assessment, personalized strategy. Then I pulled the filings. According to Morningstar, 2025 Robo-Advisor Landscape report, which assessed 16 major digital advice providers, the exposed reality is this. Among users aged 25 to 45, the largest demographic segment across all platforms, roughly 73% end up in a stock bond allocation. Between 60-40 and 70-30, 7 out of 10 people answered different questions, reported different incomes, stated different goals, and received functionally the same portfolio. That number does not negotiate. The 6 platforms I examined are Betterment, Wealthfront, Schwab Intelligent Portfolios, Vanguard Digital Advisor, Fidelity Go, and SoFi. They represent the overwhelming majority of pure robo-advisory assets in the United States. Betterment holds $56.4 billion in discretionary assets across 923,000 clients. Per its most recent SEC Form ADV filing, Wealthfront holds $41.7 billion in discretionary assets across 491,000 advisory clients. As disclosed in its 2025 IPO filing, Schwab Intelligent Portfolios manages an estimated $89.5 billion, according to Condor Capital's June 2025 estimate. Since Schwab's advisory subsidiary is no longer SEC-registered, Vanguard Digital Advisor, the pure robo-arm, managed approximately $19 billion as of mid-2024, though the parent entity reports $300 billion. When bundled with its hybrid human advisory service, Fidelity Go and SoFi round out the set. SoFi manages $1.5 billion, smallest by assets, but the highest returning platform over the trailing 3 years, at 16.63% annualized. According to Condor Capital's data through September 2025, every one of these platforms begins with a questionnaire. The questionnaire is the entire premise. It is the machine that turns your financial life into a portfolio. Wealthfront designed its service to ask what it calls the minimum number of questions, to accurately determine an individual's risk tolerance. The result is a risk score on a scale of 0.5 to 10. Fidelity Go uses a risk tolerance questionnaire that buckets investors into one of 8 risk levels. Schwab uses 12 risk profiles. Wealthfront offers 20. E-Trade uses 6. That is the range 6 to 20 possible outputs from a process. That is supposed to map the full complexity of your financial life. Think of it as a vending machine. You press a few buttons. The machine has 3 shelves. Most people land on the middle shelf. Nobody talks about this at dinner. Now, the fees. Betterment charges 0.25% annually. Wealthfront charges 0.25%. SoFi charges 0.25% after its late 2024 overhaul. Fidelity Go is free for accounts under $25,000. Then, 0.35%. Schwab Intelligent Portfolios charges 0 in advisory fees, but allocates 6 to 30% of your portfolio to cash, which Schwab deposits in affiliated bank accounts. In June 2022, the SEC charged Schwab subsidiaries with misleading clients about this cash allocation. Schwab agreed to pay $187 million to harmed clients. The SEC's order stated that from March 2015 through November 2018, Schwab claimed the cash allocation was determined by sophisticated economic algorithms, optimizing client outcomes. It was not. The cash generated revenue for Schwab's affiliated banks. Vanguard Digital Advisor charges 0.15%, the lowest advisory fee in the group, with underlying fund expense ratios averaging 0.08%. These are the prices. The question is what you are paying for. Take a person, a 30-year-old project coordinator in Charlotte making $68,000 a year. They set up a Betterment account 3 years ago. They contribute $500 a month. They answered the onboarding questionnaire. The algorithm assigned them a portfolio. They have never looked at the allocation breakdown. They assume the word personalized means the portfolio was built for them. According to Betterment's own published methodology, the default state for the core portfolio strategy is an allocation of 90% stocks and 10% bonds in a tax-deferred account. But Morningstar's analysis found that the majority of users in the 25 to 45 age range across the 6 major platforms end up not at 90-10 but clustered between 60-40 and 70-30. That is a gap. The platforms publish defaults as one thing. The questionnaires' behavioral mechanics produce another. This is not one person's problem. This is the math for anyone in that age bracket, that income range. On any of these platforms, the formula is straightforward. The result is not. I checked. The Vanguard Target Retirement 2050 Fund, a single fund designed for someone planning to retire around 2050, holds an allocation of 52.6% U.S. stocks, 36.8% international stocks, 7.5% U.S. bonds, and 3.1% international bonds. According to Vanguard's official fact sheet dated the 31st of March, 2026, that is roughly 90-10, the expense ratio is 0.08%. No questionnaire, no algorithm, no behavioral economics assessment, no risk score. You pick a retirement year, and the fund allocates accordingly. The 10-year annualized return as of the 31st of March 2026 was 10.78%. These numbers come from official fund documents. They are not a prescription. Consult a licensed professional before applying any of this to your specific situation. But the comparison raises a structural question that the industry has not answered publicly. If a 30-year-old with a 25-year horizon is placed by a robo-advisor into a 65-35 portfolio instead of a 90-10 portfolio, and the difference in risk-adjusted annual return is even 1%, the cost over time is not trivial. Start with $500 a month. Assume a 7% annualized return for the 90-10 allocation and 6% for the 65-35 allocation, net of fees. After 25 years at 7%, that monthly $500 grows to approximately $405,000. At 6%, it grows to approximately $346,000. The gap is $59,000. That is the cost of the middle shelf. The vending machine did not malfunction. It did exactly what it was built to do. It sorted the maximum number of people into the configuration. That generates the least volatility-related customer service calls, the fewest panicked withdrawals during downturns, and the smoothest quarterly retention metrics. The machine was not optimized for your retirement balance. It was optimized for platform retention. Then I found the filing. Betterment S3-year annualized trailing return through September 2025 was 14.96% per Condor Capital. Wealthfront's was 15.58%. Schwab Intelligent Portfolios came in at 13.73%, dragged by its mandatory cash allocation. Vanguard Digital Advisor's moderate portfolio returned 14.26% over the same period. These are published numbers across comparable risk profiles. The spread between the best performing platform and the worst is 1.85 percentage points on a $100,000 portfolio. That is $1,850 per year in divergence. Among platforms that all claim to be doing the same thing, your advisory fee is 0.25%. On a $100,000 balance, that is $250 a year. Over 30 years, assuming a 7% growth rate, and $500 in monthly contributions, the total portfolio reaches roughly $590,000. 0.25% of that average balance, compounded across 3 decades, amounts to roughly $22,000 in cumulative advisory fees. The Vanguard Target Retirement 2050 Fund charges 0.08%. Same calculation, cumulative cost, approximately $7,000. The difference is $15,000. $15,000 to operate the vending machine. The project coordinator in Charlotte has never seen this math. They were told personalized. They received a middle shelf allocation, available to 7 out of 10 users their age on every major platform. Strip away the marketing language and the risk questionnaires, and what you have is a person who paid 0.25%. and received a portfolio that a 0.08% fund would have replicated or outperformed in some periods. The difference is $15,000. That is the whole story. But here is the part that should unsettle you. The robo-advisor industry manages between $634 billion and $754 billion in the United States alone, according to Cerulli Associates' 2024 data cited by Morningstar. That is a fraction of the $36.8 trillion retail market. But within that fraction, the revenue model is not advisory. The revenue model is aggregation. Betterment has 923,000 clients. At 0.25% on an average account, the fee per user is modest. The margin comes from volume. The margin comes from keeping those 923,000 people in portfolios that do not generate support tickets, do not trigger rebalancing alerts, and do not produce the kind of drawdowns that cause someone to call customer service at 10 on a Tuesday night. Nobody in the industry lost their job when the portfolios underperformed a free target date fund worth reading twice. Now fold in the one premium feature that robo-advisors market as justifying the fee. Tax loss harvesting. Betterment offers it. Wealthfront offers it. Schwab offers it. The claimed benefit ranges from a multiple of the advisory fee, according to Wealthfront's own research, to more modest estimates from independent researchers. But tax loss harvesting only generates value in taxable accounts, not in IRAs or 401ks, and it only generates meaningful value in the early years of an account, when there are losses to harvest. Once a portfolio has appreciated significantly, harvesting opportunities diminish. For the project coordinator in Charlotte, contributing $500 a month into a Roth IRA, tax loss harvesting provides exactly zero value. The feature they are implicitly paying for does not apply to their account type. There is a version of this where robo-advisors provide genuine value. Automatic rebalancing is real. Behavioral guardrails against panic selling are real. Glide path construction that adjusts allocation as you age is real. Betterment and Vanguard Digital Advisor both offer glide paths. These features matter. They are worth something. Whether they are worth 0.25% annually on a portfolio that a 0.08% target date fund replicates in some configurations is the question the project coordinator in Charlotte needs to answer with their own numbers. not the platform's marketing page. The vending machine is still running. It will accept your deposit. It will ask you 4 to 10 questions. It will assign you a risk score. And in 7 out of 10 cases, if you are between 25 and 45 years old, it will hand you a portfolio that sits on the same shelf as everyone else who pressed the same general set of buttons. The machine charges you 0.25% for the selection process. The fund on the bottom shelf, the one nobody pointed you toward, charges 0.08%. Its allocation for a 30-year-old is 90-10. The Robo-Advisor's allocation for the same person is 65-35. One of them assumes you have decades to recover from volatility. The other assumes you will call customer service. 0.25% and 0.08%. $15,000 apart over 30 years. 65-35 and 90-10, $59,000 apart over 25 years. The questions were personalized. The portfolio was not.